One of the main reasons I was able to jump into real estate and build a portfolio worth over $1.5 million in just under 2 years was because of my ETF portfolio. I'm going to share with you 6 best ETFs for your Roth IRA to retire a millionaire. I'm Rosie. You just gotta do it scared. A Roth IRA is one of the best wealth building tools out there. And the best part, it becomes tax-free money in retirement. You can sign up for one just like you would a savings or checking account. So where can you sign up? With brokerages like your Vanguard, Fidelity, Mr. Schwab, Charlie Schwab, and I've even heard of apps like M1 Finance or Robinhood that you can use. But here's the key. Just opening up your Roth IRA is not enough. Think of your Roth IRA like a grocery basket. First, you transfer money into it. That's like walking into the store and putting cash in your basket. But just having the money sit in your basket doesn't do anything, right? As you go down the aisles, you're picking things that you want. You're picking things that you need. So with your Roth IRA, it's exactly the same thing. You're choosing what to invest in. So just like in the grocery store, you're picking things that you need that will serve you, and then you're buying it. That's actually exactly how I want you to think when it comes to choosing the right investments for your Roth IRA. So your Roth IRA is just the basket that holds the investments that you choose to invest in it. But I've got some rosy rules. It's easy to win with investing if you can be consistent, okay? Every month putting something in it. Just automate it the best way you can. 2, you're in it for the long haul. And 3, if you keep it simple, you're more likely to win. So consider VOO. It's Vanguard's S&P 500 ETF. VOO was and is that girl. It tracks the S&P 500, which is basically 500 of the largest US companies. And I'll consider it a solid investment as the backbone of any solid investment strategy. And because it holds some of the biggest and most established companies, it's considered to be safer. Why the air quotes? Well, most people will not share this, but I have to let you know that investing is risky. It doesn't matter how safe it is. My rule that I stick by, only invest money that you're willing to lose. VOO is diversified, just like I explained a bit earlier. Even the ETF needs to be diversified to be successful. It has a super low expense ratio of 0.03. Yeah. So that means that every $10,000 that you put in, your fee is just about $3. Now compare that to some actively managed funds. Imagine if someone else was investing for you. That's 0.03%. Everybody pays that. But then on top of that, you got to pay somebody else to invest for you when you could have just signed up for a brokerage account and just bought it yourself. So let's say that you maxed out 7K. That's the max that is given to us for our Roth IRA. And you just did VOO every year. And let's assume a 10% return that's based on VOO's historical performance. In 30 years, you'd be looking at over $1 million in your account. That's the power of compound interest. Start now. The second one I have for you is Vanguard's Total Stock Market ETF, VTI. Now, VOO gives you exposure to the top 500 US companies. VTI goes even further. It includes over 3,500 stocks. That's basically the whole US stock market. So VTI tracks small, mid, and large companies. This is important because it's more diversified than VOO, but with a little bit more volatility. And its performance has been quite similar to that of VOO. And its expense ratio is at 0.03 as well. Now, if you invested solely into VTI, there's potential that it could outpace VOO, but it also comes with a little volatility. The third one I want us to look into is called iShares Core MSCI, EAFE. Yes, I'm reading this for you because I want you to go and Google it and look at the history and the expense ratio. And its ticker symbol is IEFA. Okay, so by now you understand how ETFs give you exposure to different facets of the market. Now, IEFA gives you exposure to developed markets outside of the US and Canada. Think Europe, Asia, yeah. Well, why would you think of this? Well, it diversifies beyond the US. And I actually have a really cool community building in here of individuals watching internationally. So this could be one to look for and find the right reputable brokerage firm to see if this would be a fit for you. Oh, and to note, its expense ratio is 0.07. Now, international stocks don't always outperform the US market, but at this rate, who knows? It can add balance to your portfolio though. At number 4 is Invesco's QQQ Trust. QQQ. I feel like I'm saying the Qs. Please don't come from you. I'm just talking about ETFs. Okay, this one tracks the NASDAQ 100. This is an index that basically tracks 100 of the top non-financial companies that's on the NASDAQ. So we're talking your Apple, your Microsoft, your Nvidia. Being in tech and understanding the value projection of these tech giants, I'll confidently put my money there. So why QQQ? Historically, it has had higher returns than the S&P 500, but high risk, high reward. So its expense ratio is 0.2%, a bit higher than the others, but still pretty reasonable. Now here's the magic. If we assume an aggressive 12% annual return on QQQ, which is not unlikely, it's performed at that rate in the past before based on historical data. But listen, maxing your $7,000 in QQQ for 30 years yields you over $1.5 million in retirement, tax-free. Ooh, get on it. So our fifth one is Vanguard's real estate ETF. It's called VNQ. Check it out. Will I be rosy if I didn't talk about real estate? Hello. So VNQ tracks real estate investment trusts, is what they call REITs, which means you can invest in real estate without actually buying and getting into the property. Now, I still love this side, but you gotta be ready to bump your knees to get all the benefit. If all that headache and you still want to get into real estate, look into ETFs that track REITs. This also allows you to diversify your portfolio, and it typically pays higher dividends than general stocks, and its expense ratio is 0.12%. Okay, I like to make things a bit more tangible. So let's say you took your 7K max that's offered and you put it only in VNQ. Well, in 30 years, you're looking at over 700 grand that the market has just done its ups, its down, and just given you this gift because you decided to invest your money. And number 6 on our list is iShares Core US Aggregate Bond ETF. And that ticker symbol is AGG. Now, this one is a bond, and bonds to me stand for boring, but you gotta get balance, especially with all that's going on in the market right now. Because if you think about high yield savings accounts, they're given about the same interest rates, I think just under 5% or maybe a little over 4% with high yield savings accounts, and that's about the same that bonds are giving. So why would you choose a bond? Well, when you think about the high yield savings account, again, that interest rate can fluctuate, right? Depending on what's going on with the market's interest rate. But with a bond, it's predictable on the interest rate that you're going to get. So low risk and steady return. But I've seen some bonds provide tax-free interest. It's a great way to also protect your money, especially when the market is quite unpredictable. There's a general rule, right? They say you should own your age as a percentage of bonds in your total portfolio. So me being Forever 21, side eye, my bond percentage is about 20%. So AGG as an ETF will give you exposure to the US investment grade bonds, treasuries, corporate bonds, and mortgage-backed securities. Basically, these are promises to repay back borrowed money. We know how great that's going. The beauty about ETFs is you can mix and match to create a diversified portfolio. Put ETF in the comment so I know that you mean business when it comes to your future and investing for yourself. I believe in your ability to change your life. And remember, around here, we do it skate.